Welcome to the Passive Income Podcast. I am your host, Dividend Dave. Please be sure to join the Passive Income Posse by clicking that subscribe button below. Click subscribe. Just click it. Click subscribe. Super excited for this episode. Today's guest, Stuart, the stodgy investor. I'm just going to let you give yourself a bit of a brief introduction.
Great. Thanks, Dave, for inviting me to have a chat on your podcast. Your podcasts are really helping to bring the dividend community together, not only in Canada, but throughout the world. And it's pretty cool.
Yeah, thank
Uh,
you.
so, a brief background: I was born and raised in the West Island of Montreal, Quebec. Spent the weekends in the Laurentians, north of Montreal, as a kid. And then I went to university, studied mechanical engineering at the University of Waterloo, and followed that up later with got my master's degree and also in engineering at McGill University. So during my career, I worked at the Department of National Defense and the National Research Council, and my specialty was in the area of fuels and combustion. Retired in 2018 with a pension and worked part time for a couple of years after that, and really been retired full time since COVID started.
Right.
So I'm a do yourself investor, and I also manage some of the family investments as well.
Oh, cool. So you kind of helping some family members, brothers, sisters, cousins, nieces, nephews, whomever.
Yeah, it's a family company that my dad formed and my mom's been running for the past, I guess, 30 or 40 years.
Oh, wow. Oh, wow. That's interesting as well. That's very interesting.
Hmm.
So the a lot of things to unpack there just with your introduction. So obviously, highly educated, master's degree in engineering at McGill. Not everyone gets one of those, right?
Yeah, it gives me kind of a different perspective than probably a lot of investors have, because I kind of know how things happen, and I try to use that to my benefit in my investing.
Right, right. And then you mentioned fuel and combustibles. So uh, are you kind of heavy into like the oil and gas sector?
I have definitely holdings in the oil and gas, but as you know, it's a pretty volatile sector. So I I try to have a weighting in it. I own both of the pipelines, Enbridge and Trans or TC Energy, um, and I own Imperial Oil. So that's what I own in the energy sector right now.
Right, right, right. Now, you did mention too that you said you retired on a pension, and so I'm kind of curious about the investing journey. When did the investing journey start, and looking at sort of that passive income to help supplement that pension?
Yeah, well, I've been investing ever since the first investment I can remember is the Canada Savings Bonds Series 36, way back in November 1981. And it paid a 19.5% interest in the first year,
Oh, wow.
which is pretty incredible when you think about it. And I
Right,
think it averaged something like 12% over the, 10 to 12% over the 7 years that it was in existence. So obviously I held it to maturity. Um, So that was even before I graduated from university. I had that Canada Savings Bond, and so after I graduated from university, I got into mutual funds. I way back in those days, you bought stocks in lots, which are 100 shares,
right.
and the fees were quite substantial to buy.
We've talked about that a lot here. I've had a lot of younger guests on the passive income podcast that just can't even comprehend what we paid for fees back in the day, right?
Yeah, I think it was, I think it could total up to $200 or something like that. So basically, once you had a stock, you were stuck with it.
More or less.
Uh, so I had a choice: either build, one stock at a time, or go to mutual funds and get the diversification. Because I don't think there were ETFs back then. Certainly not that I can remember.
Yeah, and
So,
I
anyways,
don't
I
recall either.
I took the option to pay the 2% MERs, which I did until roughly Y2K, I guess, year 2000. But didn't always have positive results. I mean, most of the mutual funds did well at the beginning, and then a few years later they petered out, or other things happened. The advisor would leave, or well, I mean, around Y2K, obviously the value stocks weren't in favor, and so there was tons and tons of withdrawals by people, investors from these funds, and they
Yeah.
basically killed a lot of the funds. And so after Y2K, I kind of decided, I'd had enough of that.
Yeah, and no, I remember those days as well. I'm also getting along in the tooth, but it sounds like I'm a couple of years younger than you. In 1981, I was about I think 8 years old. So by the
Mhm.
early 90s, I too was sort of looking at those mutual funds and going, this seems to be like sort of what makes sense right now. And because yeah, like by the early 90s, I was like a you know late teens, early 20s, and it was like, I can't just go out and buy 100 shares of a company that the stock price is even say $25 a share. It's like, I didn't have $2,500 to put into a company at that time. So, yeah, at the time, mutual funds did make a lot of sense.
Yeah, they kind of tricked you because they had no upfront fees, but if you tried to get your money back,
Yeah, a lot of
on
them
the
were
first five or
backloaded,
six,
right?
yeah, they had the backloaded fees, which kind of killed you.
Right. Yeah, yeah, yeah.
So basically, after Y2K, I had enough money that I started going, more into the individual stocks rather than paying for mutual funds.
Yeah, and even by around the year 2000, when online banking became a thing, and you could buy stocks within your online banking, whether you're banking with TD or Royal Bank or whoever. But even at the time, I recall all of a sudden, like the fees were still 29.95 per trade, right? And it's like
Yeah,
you think of those fees in this day and age, it's like, who's gonna pay $30 for every single trade, whether it's a buy or a sell? And again, you have to kinda go, "Well, I need to stack up enough shares," like, say, 50 or 100 shares of a company to make that $30, literally $60 to buy and sell it, right? To make it worthwhile, and I need that share to appreciate in value to at least
yeah,
cover my $60, right?
yeah. It was relatively rough days compared to now.
Oh, for sure, for sure, and then I remember it going down to 9.95, and I think some of them might even still be at 9.95, and you're like and they were some of the like, I'm with Royal Bank on that one, in my direct investing, which I haven't even used now in years because 'cause I'm with Wealthsimple, like, 0 commission fees, so it's like and I remember Royal Bank when they went to 9.95, and they thought it was, like, the greatest thing since sliced bread, and I'm still like, "That's ten bucks on every trade," right?
Yeah, yeah. I'm still with the major banks, so I'm paying the 9.95 or whatever for my trades.
Right.
But
Yeah, and honestly, like, I mean, it's hard to kinda there's a point where that $10 doesn't hurt you as much, but at the end of the day, that's still 10 bucks that you're just paying them to literally for the service of being able to use their website. Like, come on, it's a website, you're doing all the work, you're the one clicking the buttons, right? Like, it's all automated these days.
yeah. Well, I mean, I don't know. On Wealthsimple, do you get like level two quotes?
No, it's, actually, with it you can pay for, tiers on Wealthsimple, so if you pay, you can have like, you can, get no commissions on US stocks, and you can get up to the minute, um, quotes, but if you just have the free service, the quotes are, like, 15 minutes behind. But again, if you're just buying for the dividends and your dollar cost averaging, you're not overly concerned with 15 minutes, right?
Yeah.
I am gonna
So,
give a quick
yep.
I before we get any further into this, I'm gonna give a quick shout out to Buy Investing Shirts. Patrick, you guys have seen me wear the dividends, ball cap, uh, the toque. You're Canadian, you know what a toque is. The Passive Income Pod Posse t-shirt. Definitely check out the merchandise over on Buy Investing Shirts. He's got tons of great stuff over there. Um, Hoodies and coffee mugs and all sorts of stuff. I'll have the link in the description below, and use the code word Posse for 5% discount on your purchase. Let's keep going.
Sounds like a deal.
It's a great deal. If you haven't been to that website yet, definitely check it out. He's got some really cool merchandise there.
Great. I'll do that right after.
Nice, nice. So, kind of moving forward through the '90s and into the 2000s, and we get into sort of more, I guess, like you said, or like we agree, sort of more independent investing, and you know, mutual funds have become sort of more of a thing of the past. I know you can still buy them, obviously, but and then you get into sort of the individual stocks, and then what got you going in the individual stocks? What were the companies that first really, you know, lit a fire for you?
Um, to be honest, I can't remember exactly what companies I started with. Um,
That's what happens
I
when you
think,
get to our age.
yeah, that's for sure. But I mean, what I do remember is that right from the time I was a kid, my dad was investing, and he used to watch Louis Rockheiser religiously on PBS, and he used to look through his newsletters and stuff like that. So I mean, I always knew at
Right,
some point I'd become a stock investor, rather than mutual funds. And after dealing with the mutual funds for years and finding all the pitfalls, I mean, that kind of sealed the deal for me.
right, right,
So
right.
so what I'm really focusing on now, I mean, I've always been what I call a conservative investor, but probably as time's gone on, I've become more focused on the dividend growth part of it.
Yes,
Um, because I mean, I like the dividends because they reduce risk. I'm not buying startup companies. I'm not buying fast growing companies that could go bankrupt. I'm not buying bad and fraudulent companies. I'm willing to make that trade off to, sleep well at night. No
yeah,
one,
and
no,
that's
no one
like,
seems to talk about that, but dividends. When the company has to pay out money, it has to get some money from somewhere.
yeah, exactly. And you're preaching to the choir of the audience of this of the passive income podcast. Like, dividend growth, sleep well at night. Those are kind of two main key ingredients, right? Like,
Yeah,
and I say it all the time. What I love about dividends is these companies literally pay me to not work for them.
yeah,
It's like, I do not work for Bell Canada. Every
yeah.
3 months, Bell Canada pays me, right? Like,
It's good.
right?
Yeah. So the next thing, that as I've come further along in my journey, I really appreciate the importance of the dividend growth,
Right.
because if you don't have the growth, I mean, you're getting your dividend every year, but it's really buying you less. So if your dividend isn't growing by at least 3%, or the level of inflation, then it's not really helping you, in my opinion.
Yeah,
So that's where that's kind of where I'm going towards more is, getting stocks that have, good sustainable dividend growth.
yeah, and you mentioned the inflation there, and obviously this last year and a half, even almost 2 years now of, like, insane inflation and no dividend. Very few companies, I don't know of any that have raised a dividend by 7% to keep up with that inflation. But I agree with you over time of, like, that average 2% inflation. If your dividend is growing by 3%, then you're outpacing inflation, so you're winning, right?
Yeah. So I think that's very key, where I see some people just chasing yield, but not getting any growth. I
Right.
mean, that's a bit dangerous.
Yeah, for sure, and I've admitted it. I've admitted it on many of these episodes of the Passive Income Podcast. I've been guilty of chasing yield on a few occasions, so
Mm. So my kind of philosophy is I'm looking at there's three ways to get a return from a stock. There's the obvious one that we all talk about is the dividend yield,
right,
but there's also earnings growth. And, for a mature company, the earnings growth is usually pretty similar to the dividend growth, when you're talking about a high quality company. So the return you get from the stock is equal to the dividend yield plus the dividend growth. And then plus there's this, price to earnings adjustment, where sometimes the market will pay more for a dollar of earnings, and sometimes they pay less.
right.
So when I'm looking, I look at the stock first, what's its dividend yield plus its earnings growth, because that's what I think is the long-term return from the stock. And then I try to buy it when the, price to earnings ratio is favorable
Yep,
or the yield is higher than normal. So
interesting.
that's how I look at, evaluating stocks, at least, from a screening perspective.
Yeah, so kinda since you've kinda you know, you said sort of somewhere there in the mid-2000s, you started focusing more on, obviously, the individual stocks, got away from the mutual fund, started looking really at dividend growth, and then was there any sectors that you focused on or any companies that you focused on in those in any particular sector?
Um, Not in particular, because I think on my website I listed some of the resources I used at the beginning. One of them was the investment reporter that's been around for almost 100 years now, and it always told you should be investing in the major sectors of the economy, and kind of have a balanced portfolio.
Right.
And so that's kind of been my strategy all along. Because if you don't have a balanced portfolio, if you're all focused in one sector, then if another sector takes off, you're left behind. And it seems to work best if you have stocks that are covering a wide range of parts of the economy, and that don't necessarily respond the same way to different pieces of news.
Yeah, right, and you mentioned your website and your blog post, so I will have the link in the description, and obviously, I'm not sure why that's not coming up. So, anyone that wants to check out the stodgyinvestor.com, like I said, the link will be in the description.
Yeah, I basically just started stodgyinvestor.com during the pandemic. Um, you know, Sitting in the house for long hours. Um, I
Kinda
did.
became something to do.
Yeah, I read. I mean, I decided I was going to make myself a better investor and understand more. So I read a bunch of books, and then I said, "Well, now that I have this information, maybe I should just share it." And
Right.
you know, bounce some ideas off, and if people have any comments on them, it's great. But otherwise, it's just for me to uh, make the ideas more concrete in my head and have them as a record, so that I can go back over time.
Right. Cool, cool, cool. I do wanna kinda dive into some different sectors here that, obviously, we talked about oil and gas there a little bit off the top. Um, obviously, you're Canadian and, one of the hot topics in the div twit community, even with American investors, they love asking us questions about the Canadian banks, and I'm guessing your opinion is similar to everyone else's opinion is like, "Look, they've been paying dividends for nearly 200 years,"
Yeah.
right? Like, so yeah, I'll just let you take a
Yeah.
sip there and get your thoughts on the Canadian
Was
banks.
I started out being kind of a nervous investor, and I find the banks a challenge in a way because everything looks good until they don't look good. And it's like so you just have to accept that you know they're going to have setbacks from time, and their stock price is going to go down. And if you're smart, you buy some more shares in the company. and carry on because, they'll rebound and do well.
Yeah, dollar cost average down, but even when those share prices go down, you're still getting that dividend, right?
Yeah, I
So,
mean, that's so far they've been, really good at least paying their dividend if they don't increase it. So
yeah,
in the
exactly.
fo Go ahead.
Well, like I said, some of them are like I think it's BMO is coming up on a 200-year anniversary in 2029, and then Bank of Nova Scotia not far behind that in I believe 2033, 200 years of paying dividends. And obviously they haven't increased a dividend every single year in 200 years, but I look at that longevity and consistency and go, wow, like I can't name another. I don't know of any other company anywhere in the world that's maybe there is somewhere out there on another exchange in Europe or somewhere or in Asia that has been paying dividends that long, but I'm not aware of them.
Yeah, it's pretty impressive considering the financial sector is I won't say one of the riskier sectors, but it's not the steadiest of all the sectors, that's for sure.
It does seem that again, this is Canada being right beside neighbors with the U.S. When the U.S. sneezes, Canada catches a cold, and we saw it in 2008 with the housing crisis, and now we're seeing it again with the like Silicon Valley Bank and other regional banks. But I just keep coming back to those Canadian banks that have been paying dividends for even the shortest time frame. I think Royal Bank is still well over 150
Uh,
years, right? So
yeah,
it's just really tough to argue with the longevity and
yeah,
consistency.
pretty much every Canadian investor should own, a couple of Canadian banks.
Hey, buddy. Sorry about
Oh,
that.
no problem.
He's just making sure we're all
Yeah.
awake. Startled me for sure.
Yeah, so in the financial sector, I own Royal Bank and TD Bank, which are the 2 biggest banks. Um,
Yeah,
and, for insurance companies, I own both Sun Life, which I've owned for a long time, and Power Corporation as well. But I
right,
think I
yeah.
actually both
I have a bit of Power Core, not a whole
uh,
lot, but I have some. It's nice.
I think I initially bought
That's
the,
actually
Power Financial, and then it got converted over to Power, and I've kind of added to it.
right, right. Actually, that was one where recently it was down and I'm probably kind of well, I'm not kind of. I am kicking myself for not dollar cost averaging down and buying more shares into it because just over the last few months it's kind of been down, but you kind of know it's going to go back up, right? And it's like I should have bought more, but it's tough to buy them all.
Yeah. Well, I mean, the insurance company's been facing the headwinds of the low interest rates for, a long time. And,
Right.
I expect they're gonna do much better in the future, now that we're getting, 3, 4, 5% interest rates.
Yeah. Another sector, the telecoms. Obviously, Bell has been around for well over 100 years. Telus is quite the company as well. Rogers trying to take over Shaw Communications. I haven't really been following exactly what's going on with that merger slash acquisition, simply because it's been dragging on now for like a year. I think it's been nearly a year, right?
Yeah, I kinda lost track of it too. I used to own Bell, BCE, and then, I kinda got tired of them after a while. Um, I listened to the TSN radio station, and, one of my favorite announcers got laid off, in March when they do their layoffs right after their Bell Let's Talk. And and
Right.
and and I just said, "This is ridiculous." If they have to lay off guys who are doing a good job for the company, I just said, "I don't wanna be supporting that." So I sold my Bell and bought TELUS and been owning it ever since.
Yeah, I own a little bit of Bell. I'm starting to kind of try to stack that one. I don't own any Telus. Not that I think there's anything wrong with the company. Again, it just goes back to you can't own everything. Maybe in the future someday I will open up as a position in Telus. Who knows? And I know that again back to Rogers and that whole thing with Shaw. It just seems to be dragging on and on. It's like they they just really need to come to a conclusion at some point and say, okay,
Yeah,
this is the end game here, and then right, like,
there's a lot of politics involved in it. So, you know, it's tough when there's more politics than, common sense.
yeah, well, yeah, and unfortunately, politics and common sense do not go hand in hand. I think everyone from any country in the world can probably agree with
Yeah.
that. um, okay, well, quickly moving on. That's some great thoughts on the telecom sector. Uh, Food, consumer staples, consumer discretionary. I love sort of the food industry. I work in the food industry, so I'm like, you know what? People are going to eat every day. People have to eat. It it's got to be somewhat recession proof because people are still eating whether the economy is booming or bust. You still have to eat every day. So I guess any thoughts on anything in and I do kind of lump the two together of consumer staples and consumer discretionary. So any thoughts on anything any companies in those
Yeah,
sectors?
I own a few in the consumer sector. Uh, Probably my biggest holding of my whole portfolio is Alimentation Couche-Tard.
Right.
It's, been a fabulous performer, and I see no reason why they're not gonna continue growing in the future. So that's a big holding, and, they give you access to, all the sins of the world without,
Yeah.
without directly owning a cigarette company or a
Or
beer
a beer
company,
company or whatever.
or pot potentially in the future, so that they're gonna sell it all. And junk food, I guess they got that covered as well. And they
Yeah.
sell gasoline.
Yeah, and, just for those who don't know, that's ticker symbol ATD, and they are huge, primarily in Quebec, but also in other parts of Canada. I think Western New Brunswick as well. But they're more or less
Well, the
like convenience stores and gas stations. And in Quebec, you can buy alcohol in the convenience
yeah,
store. So yeah, yeah, like you said, they have the cigarettes, the alcohol, the um, snack food. So you've got your Pepsis, your Cokes, you've got your, so many companies that are covered just by owning that
yeah.
one stock. And yeah, I don't own them personally, but I've looked at that company going, nothing wrong with that one,
No, I don't think it's going anywhere. I also own Metro, which ticker symbol MRU.
right?
It's been one of the better performing grocers. Has a 28-year record of increasing their dividend, and still increases their dividend by about 10% a year.
Yeah.
So I'm pretty happy to own that one. Also own Canadian Tire, uh,
Nice.
CTC.A. I mean, it's got a dividend growth of about 12% per year. So, it also owns, it also owns the Sport Check and the Sports Experts and Marks
Mark's Work Wearhouse.
and Helly Hansen, I guess.
Right.
So it's done pretty well over time. It's kind of a
Yeah, a couple
cyclical company, but it always rebounds. So it's one of those ones. If you can catch it on a deal, you can actually do quite well.
yeah, a couple things there. Metro, huge grocer in Ontario and Quebec. I'm not sure, at least 120, if not 160 stores. And yeah, just in the last year, I think their share price has gone from somewhere in the $55 range up to the 70 some dollar range. So great capital appreciation on that share over the last year. And then Canadian Tire, oddly enough, just I think it was just the last episode of the Passive Income Podcast where I was saying, "You know what? We never talk about Canadian Tire on here. Not with any other Canadians. We never talk about Canadian Tire." And we got talking about how, like, any kid who has played hockey in Canada has gotten something from Canadian Tire, whether it's skates or a stick or a helmet or gloves or shoulder pads or shin pads, or if you've played hockey in Canada, you got something from Canadian
Uh,
Tire,
uh,
guaranteed.
yeah, I mean, it covers a lot of areas and does a reasonable job. And Everyone counted it out when Walmart came to Canada, and Canadian Tire is still here, and there's lots of other
Yeah,
companies that aren't here, so they're doing something right.
like Target.
Yeah, so I own that. And the last one I own is just a very small position, Unilever. I think you had a guest on recently that talked a little bit about it.
Yeah, I've had a few different guests talk about Unilever. Obviously, similar to a Procter and Gamble, where they just have tons of household items, and you could go through your kitchen or bathroom or whatever room in your house, and odds are good you're gonna find Unilever
Yeah,
on the back of a product.
and the reason I bought that over Procter and Gamble is they seem to have more penetration into the emerging markets. And so that was one
Right.
of the ways I could, choose that company over Procter and Gamble and get a little bit away from the U.S. Canada, U.S. centric, more towards, covering the world a little better.
Yeah, that's very understandable. So is that kind of a wrap on your
That's the
consumer.
consumers. Yeah,
Cool, cool, cool. REITs. I love my REITs, and obviously one of the big advantages of REITs is that monthly dividend. And I seem to say this on almost every single episode of the Passive Income Podcast. Is like, I get it. 5% is 5%, whether they pay that 5% quarterly or monthly. But there's just something psychologically nice to see that go into your account every month on the, say it's the 7th or the 15th or 16th or 24th of every
yeah,
month. It just shows up another whatever it is, 10, 20, $200, and it's just there every month.
yeah.
Just
You're gonna be disappointed in me on this one though. I don't own any REITs at all. Um,
oh, okay,
I have
fair
looked.
enough, fair enough, and
I have looked. Um, I would buy Canadian apartment REITs, but when I look at
yeah,
it,
that's a good one. I don't own it, but it's been on my watch list forever.
my problem is that when I look at it, it has a dividend yield of about 3%. I don't know what it is now. I haven't looked at it in a while, but it usually has a dividend yield around 3% and has growth around 3%. And so, I'm coming up with 6%, whereas other stocks I'm looking at are, 10, 12, 15. Um,
Right,
so I guess you use it to replace bonds, as a bond equivalent in your portfolio. But in
right.
my case, I've got a pension, so I think that's probably the reason why I haven't, pulled the plug and bought any of the REITs yet. I did look at one. I forget what it was called. Canadian Net. It's a small REIT.
I'm not familiar with that one.
It had like a very high dividend or distribution growth rate. Over 10%, I think. But when I looked at the company, I mean, I didn't see anything I didn't like about the company, but the reason it was growing so fast is it was, a newer company and it was building up, debt as they went along. And so that seemed to have juiced the results, over the past decade or so. So I'm still watching that one to see, what happens when it gets to a steady state.
Right, right. I do kinda have to ask you though, like, thoughts on the REITs like RioCan and Smart Centers?
I mean, I have followed RioCan. I guess I don't really understand the real estate business that well, and that's there's been all this shift for people not going to work, and then people saying retail's dead. Well, I don't completely buy that because I own Canadian Tire. It's
Right.
just
Well, people shop online, like, right?
yeah, but I mean,
Canadian Tire has great online shopping. I do it for my work. I buy things online from Canadian Tire.
yeah, I mean they've definitely adapted that way, and their app is pretty good. I don't know if you've used that. We have to go in if you want to go into the store and find something quickly.
Yeah, it tells you
It
what
tells you
aisle
what
it's in.
aisle and how many of them are there, and you can because
Yeah.
otherwise some of this. I mean, that Canadian Tire store they open up in Ottawa now is supposedly just absolutely huge. I don't know if you've heard about it.
No, I haven't. No, I haven't.
I think
Not.
it's like a
I haven't been to
I
Ottawa
don't know
in
whether it's
over a year now.
multi-floor
So
or I think it's in a mall. It was in a mall, and it's supposed to be absolutely huge, like their biggest store ever.
interesting. I have a couple thoughts here.
Yeah,
So one, sort of the real estate market and why I love my REITs is because I get to invest in that real estate, and it's not all office space or retail, and like like you said, apartments, and there's all sorts of opportunity in real estate. And what I love about the REITs is I get to own a piece of real estate without being the landlord. I don't have the headaches of the phone calls, and I don't have to, collect rent and chase down tenants, and I don't have to do anything.
yeah. I mean,
So
yeah.
that's my argument for REITs, right?
Oh, yeah. If you had to choose between a REIT and being a landlord, I mean, I'd be taking the REIT option any day.
Yeah, exactly. So, and then just kind of sticking with the retail with Canadian Tire, and I recently, just last night, maybe the night before, I just randomly tweeted, "Why did Target fail so badly in Canada?" And there was like tons of responses about, sort of what happened with Zellers. And so I'm kind of curious. Obviously, Hudson's Bay Company (HBC) is bringing back Zellers in sort of a limited capacity. What are your thoughts on that?
Oh, yeah. I mean, who knows? It's
Yeah,
It seems like some of these ideas just keep coming back. I guess if you don't have any new ideas, then you bring back an old idea.
just recycle, just recycle.
I don't know.
Yeah, I'm in agreement that, I mean, I think, a lot of people are gonna go to Zellers at first just for the nostalgia of
Mm,
it, of like, "Oh, I remember," even, nowadays, somebody that might be, like, sort of 25 years old, and they were like, "Oh, I remember going to the store when I was 5 or 6 years old with my mom or as a kid,"
mm.
right? Or for people our age, like, we remember sort of the Zellers in its heyday, and maybe you're gonna go there once just to relive that nostalgia, but then are you gonna go back after that one visit? So I don't know where it's going in the future either because, well, I can't predict the future.
Yeah. Although,
Plain and
I mean,
simple.
there have been enough companies have left the retail space that maybe, maybe there is an opportunity now.
And,
You know.
yeah, very possible, right? I'm kinda curious about the technology sector, especially with your engineering background. So technology, anything in technology that interests you?
Um, it's been one of those sectors that I, I think I talked about a little bit in my blog that I bought a technology sector mutual fund in like 1999 or 1998 and did well for like a year or two. And then the crash came.
The dot-com bubble.
And it was one of those things with the backload that I couldn't get out of it. And it kind of soured me on the technology sector. But, I do own one of those companies. I own some Cisco that took about 20 years after the crash to regain its previous price. Um, and they seem to be,
Better late than
yeah.
never, right?
So I mean, now they're paying a dividend and showing some dividend growth. So it's a pretty conservative company. So I own some of it. I own a little bit of House. I don't know if you've heard of it. It's a
I
Canadian.
I've seen some tweets about it for sure, yeah.
It's a Canadian company that software and services. They kind of have some asset management, looking at networks and transit and public safety, stuff like that. And then they do some interactive management, I think that's, more geared to employees working at home or customer interaction. What I like about the company is that, it was growing fairly well for quite a long period of time. It hasn't as much since the start of COVID. It's still a small cap at 250 million or so in annual revenue. And most amazingly, despite all their acquisitions, they have almost no debt. and
Oh,
and
wow.
th- and
That's impressive when
for a
you see that.
conservative investor, that's you know pretty good. So they've been growing their dividend at 15% per year, but as I said, the last couple of years, the revenue and earnings haven't kind of matched that. So I'm kind of watching them carefully. I have a small position, and if they do well, if the growth returns, then I'll be loading up on it.
Interesting. And then, like, you know, again, both of us Canadians old enough to remember Nortel and sort of what happened there. And, BlackBerry is obviously still a company, but nowhere near its former glory. And even,
Oh yeah,
Corel was a major player in the technology industry in Canada. And nowadays, Canada just does not have the competitors in the technology sector compared to the Apples and Microsofts of the world.
no. Um, I mean, I did own Shopify for a short period of time this fall. Uh, as the price was getting just absolutely hammered, I picked up some shares around, I forget, $38 or something like that. And then they started to take off again, and the day-to-day variations in the price, um, without seemingly anything behind it. I started
Right.
spending all my time looking at that one stupid stock that only, accounted for relatively small portion of my portfolio. And so it went up like 30 or 40%, and I just sold it and said,
Yeah,
forget
you're
it.
just like, "I'll take the profits and forget about trying to monitor this stock
Yeah,
24/7."
yeah, so I mean that's one of the reasons why I don't invest in a lot of technology stocks. Now, if Microsoft came back to a good price, for sure, I'm going to pick some up.
Nice, interesting, and that kinda, you know, wants me to ask you about US versus Canadian in your portfolio. What's sort of your breakdown? Are you majority Canadian? Do you have a lot of American US holdings?
I'm probably just taking a wild guess, maybe 20% US stocks, maybe 25 something. And I don't really track that closely because, I own utilities like Fortis and Emera that have significant operations in the States as well. And
Right.
so, if you look at, and Couche-Tard is, throughout the world now. Um, Royal and TD are both in the US.
Yeah,
So what I really do is I'm using the US stocks to supplement areas that Canada doesn't cover very well. And, the obvious two are technology and healthcare, um, and some
right.
big box stores, I guess, but I don't own them right now. So in the healthcare sector, I own Pfizer. I've owned it for a long, long time. I owned AbbVie, sold it last week. Um, I thought I was going to own it forever, and then I decided to raise some cash because there's some other stocks I would like to buy if they go down in price. I own J&J as
Right.
well, so Johnson and Johnson. So pretty,
And what are
pretty
your thoughts
conservative
on Johnson
picks.
and Johnson with the Johnson and Johnson split? Um, how they're, splitting into consumer goods on one side and pharmaceutical on the other. What are your thoughts on how that split is going to go?
Um, I imagine it'll go fine. I find it a bit of a pain as an investor because Pfizer split up, and I forget there's been two or three companies I own that have split off part of the company, and my stock count ends up higher than what I really want. Um, I think what J&J is their growth seems to be stalling a bit now, and so I think they're
Right.
splitting off the consumer goods so that they'll, on the healthcare side, they'll have a little more growth than what they have had in the past. So, I mean, that would be a good thing. When they split off, I'll have to decide if I keep the consumer good side or not. So,
Yeah, no, interesting. Fair points. Fair points. Uh, Jumping into another sector I love to talk about is transportation. I don't know if you've ever watched enough episodes to know that right behind those curtains, there's one going by right now. Train.
Yeah, yeah. I mean,
CNR, CP, obviously incredible companies. And then there's obviously other opportunities for in the transportation sector as well. So, and again, I go back to, the transportation sector. Farming and transportation is the backbone of the economy, right? Like without farmers and truck drivers or train conductors, your store shelves are empty. So
yeah, CNR.
that's my argument for
Yeah,
that.
CNR was on my buy list in March 2020, and to be honest, I wish I had records to know why I didn't actually end up with it. 'Cause, I mean, it's a great company. And I actually have done some work for, the railroads before, so I have a reasonable understanding, of what they do and how they make money, and they're not going anywhere, you know? Just
And a very wide moat,
yeah.
extremely wide
Well, I
moat.
mean,
Nobody's building a railroad. Nobody's gonna come along outside my window and build another
yeah,
railroad, right?
and, Kathy Woods was talking about, people using trucks, in finishing off the railroads, and that's just foolishness. Can you imagine corn and wheat, trucks one after the other going down the 401? It's just not going to happen. So
Right, no,
so
no.
CNR's
Like, I mean,
CNR's great company.
yeah, I mean, at the end of the day, trucking is still part of the equation because you have to get it from the farm to the rail yard and then from the rail yard to
Yeah,
the processing plant or wherever it's going. But in between, like you said, you're not gonna have 100 trucks going down the Trans Canada or the 401 or the 416 or any major highway. It's not just gonna be 100 trucks, it's gonna be 100 rail cars outside my
yeah,
window every hour, all day, every day.
yeah. I've got a small railway that comes right by the back of my house here. So if we're lucky, maybe we'll get a train come by. It's
Cool, I'm just gonna quickly, pop this up on the screen is, buy me a coffee. Please help support the Passive Income Podcast by clicking the link in the description below to buy me a coffee or use the QR code on your screen. Thank you so much for supporting the Passive Income Podcast and everybody who has watched so many episodes and subscribed. And I really appreciate all of you so much. Thank you so much. And yeah, let's just get back into it. I see we're already getting really close to 50 minutes. It usually doesn't take long to just keep talking. Sort of anything else you kind of want to touch on before we do come to a conclusion here of this episode?
um yeah, just a couple of random thoughts I have, I guess. Um,
Sure.
we always talk about passive income. Uh, you don't have to do anything for it, but it isn't entirely passive. I think anyone who's wants to switch from
Right.
ETFs towards looking at stocks, they're really just doing themselves a disservice if they don't read the quarterly reports for each company they own, and that does take time. So I think
Yeah, for sure. For sure.
otherwise, you might start off with good stocks, but if you don't watch them carefully, you can get some bad surprises down the road. The sec
Right. And I think that's a great point. I was just going to say it's a great point about ETFs too. Like you can kind of, with ETFs, you don't have to think nearly as much about it. Whereas with when you get into more of those individual stocks, yeah, you kinda have to keep a closer eye on it. And then, sorry, you were gonna say a second point?
Yeah, the second thing that's helped me a lot in the last couple of years is a risk management step I do. When I buy a stock, I start with an initial position, and then watch it for a period of time. And a period for me isn't like weeks. It's quarters or 2 quarters or a year or 2 years. And so I start to really understand the stock and how it trades in the stock market. I mean, I do watch stocks
Right,
before I buy them, but
course.
but I watch them much more closely. Once I own the stock, and this has kind of saved me. Like Algonquin Power, I bought an initial position in it, and I didn't exactly like what was happening. I wish I would have just sold, but at least I only had a partial position. When they cut their dividend,
Right.
and so that saved me quite a bit. As opposed to going crazy at the beginning and then
If you had just said poker table all
yeah,
in, all in on Algonquin Power,
yeah,
and then the huge dividend cut,
yeah,
whereas you're like, I'm just gonna put a little bit in and see how we do, and then that dividend cut still hurts, just doesn't hurt nearly as much.
yeah, and what it turns out is the companies in my portfolio that aren't doing as well, they tend to all be the ones I own less of. And the companies that have done well consistently, like Fortis and Couche-Tard, I own the most of them. And so,
Right.
it really is
Because you've watched them and you've
I read there were
really watched them and studied them and said, "Okay, I feel confident buying more shares of these
yeah.
companies."
The other thing I've learned, I used to always look for new companies and try something new, look at this, but my inclination now that I've been around a long time is I find there's a lot less risk in really focusing on the companies that I own and really understanding them, and as long as their performance is still acceptable, adding to them, when they're on sale. And it seems to me to work towards reducing risk more than picking new companies I might not know as well, even though I followed them for a while.
Right. Interesting. Before we wrap up, again, this is not financial advice, but is there any kind of advice that you would give to someone who is new or thinking about starting investing?
I think if you don't have the time, for sure go ETF route. There's no question about
Yeah.
that. Uh, but if you do have an interest in companies and understanding how the companies operate, how they make money, uh, then you get a lot of satisfaction from owning individual stocks and watching the companies that you own a part of do well over time. I think
Yeah, for
that's satisfaction that you just don't get from an ETF. So I think it's kind of a different mindset when you're a partial owner of a company versus you know uh, I participate in the stock market so I can make money. It's two different mindsets completely.
Yeah, that's a very interesting take on that. I hadn't really thought of the difference between ETFs and individual stocks like that in the past, but I definitely get where you're coming from on that one for sure. Awesome. Well, with that said, we've had yet another incredible conversation here on the Passive Income Podcast. I thank you so much for your time, Stuart. I really appreciate you coming on. Any last thoughts in closing before we sign off?
Uh, people should be careful these days. I don't know whether the market's going up or down, but there's a lot of geopolitical issues in the world, and there's a lot of debt in the world. So
Yeah, I think that goes well beyond the investing community. Just be careful out there,
yeah,
everywhere,
yeah,
with everything you do.
it's a really good time to buy really high quality companies and keep holding them.
All right, awesome. Well, with that said, we're gonna sign off on this episode of the Passive Income Podcast. Be sure to click the like button and subscribe.